limits on the banking system's ability to create money. Although banks are responsible for the creation of money through their lending behavior, they cannot in practice do this without limit. A number of factors impact the level of new lending and money creation. Central bank monetary policy, market forces, capital requirements, behavior of consumers. Firstly, and arguably most importantly, is central bank monetary policy. By influencing the level of interest rates in the economy, the central bank affects how much consumers can afford and wish to borrow. This can occur directly by influencing loan and mortgage rates, but also indirectly by impacting broader economic activity. Because most central banks have a monopoly on providing central bank reserves, the price which they pay on these reserves has an impact on interest rates in the broader economy. Most central banks have a mandate to control inflation. So if we consider inflation is what happens when too much money is chasing too few goods, then you can see that by raising policy rates, central banks reduce the propensity for commercial banks and consumers to create new money by increasing the cost of that new money. Or, put it another way, by reducing the affordability of new money. And that is why the central bank policy rate is such an important economic tool. Now, secondly, and closely linked to the first point, there is a finite pool of creditworthy consumers to lend to for any given level of interest rates. So when this pool is depleted, the risk-reward payoff no longer stands and lending becomes unprofitable, and money supply will slow. If banks think policy rates will rise and affordability will decline, then their propensity to create new money will fall. Prudential regulation also limits the capacity of banks to make loans and create money. All commercial banks are required to hold capital reserves to protect depositors from the impact of losses that might arise from loans in their asset base. And for every new loan, the bank must reserve more capital. The capital required to support new lending might not always be available or available at a price the bank is willing to pay. Lastly is the behavior of consumers, who can destroy money by repaying debt, or who can take out loans without increasing the money supply in the economy if they simply use the new loans to consolidate or repay other loans.